if you look at, especially in the cyclical sector like auto, uh, any such trigger earlier has led to cyclical upturn. This time as well, we need to watch out for such triggers. So when we are observing festive season numbers which are out so far, and festive season is not over yet, numbers are close to 10 to 15% higher compared to last year.
So this is like almost a bottoming out.
Yes.
Now, if we were to talk about how against all of this, you spoke about how you're positioned in your portfolios. Hello investors, welcome to Moneynomics by Axis Mutual Fund. I am Shalini Gautam and I have with me our Head of Equity, Shreyash Devalkar. Today, we will be talking about the performance of Indian equities vis-a-vis the global markets, the key triggers ahead, the way forward, how we positioned in our funds, and what should investors do in such times. So Shreyash, let's begin with the fact that Indian equities year to date have been underperforming global markets in USD dollar terms. What do you think is the reason for this underperformance and what can be the way forward?
Sure. Indian market, as you have noticed that yes, it has underperformed a lot, but one should remember that it is on the back of very sharp outperformance in the years prior to last year. So even standing today, 3-year rolling return of large cap is closer to 15-16%. 3-year rolling return of mid and small cap is closer to 20 to 23%. This is a very high and decent number, and that what it suggests that it is on the back of these high numbers of high returns which we have seen. Particularly in last 1 year, few things has happened. Globally, there has been a trade towards by AI beneficiary. If you see in the Indian listed space, there are not many large companies which can be considered as the AI beneficiary. While you will notice that the trade which happened especially in the Asian countries, in Nasdaq, whether it is in Taiwan or whether it is in China, it has been about AI beneficiary. Okay. And in that trade versus that, and we observed that because in India there are not many companies in the larger cap space especially, Indian market has underperformed. That is one more reason. The third angle to it is also to do with the tariff and the concerns over exports. So this has also led to slowdown and expectation of slowdown in many leading sectors. If you take IT is one among them, though there is no direct tariff on that, but the uncertainty on the global growth is actually taking a toll on the sectors like IT and some export-oriented sector. So this also has led to further drag on the growth of few sectors. Apart from that, recently when government has announced multiple benefits for GST, there is also a little bit concern over whether there will be compromise on infrastructure or not. As of now, there are no indications, but market has slightly tried to factor in that as well. And this, because of all these multiple reasons, the market has underperformed. Going ahead, in my opinion, there are definitely some good news. One is, as I highlighted, GST. So there is a flip side of probably if there is cut on infrastructure spend. Again, that verdict is not out yet, but definitely the GST benefit which is going to flow. Second is the tax cut. Both combined, GST plus the tax cut which was announced earlier is going to be almost 2 lakh crore kind of stimulus. Apart from that, the lower interest rate, what we are observing, better liquidity. This also is likely to improve the growth for the domestic economy. So all in all, because of this underperformance, along with some triggers for the domestic economy, I think investors should look at returns closer to nominal GDP growth, as it has been always in case of India.
Okay. You spoke about GST rationalization. Now, GST rationalization has seen two main, sectors like your automobiles and your consumer durable staples segment, have a sharp run-up. Do you think this run-up can sustain? Do you think the sector will now, see a change in fortune?
If you look at, especially in the cyclical sector like auto, any such trigger earlier has led to cyclical upturn. This time as well, we need to watch out for such triggers. So when we are observing festive season numbers which are out so far, and festive season is not over yet, numbers are close to 10 to 15% higher compared to last year. There are certain elements of lack of sales after 15th August till the GST rate cut, actually when it got affected. Adjusting for that, the stock price run up is actually much ahead of the actual growth in the volume what we are observing as of now. Sustenance of this rally will be more tested when we will try to see whether even post festive season this rate cuts is going to drive the cyclical upturn for these sectors. So if there is a cyclical upturn for these sectors, even post festive season, that kind of scenario can definitely give further upside for these sectors.
Okay. Now, we're just beginning the season with the earnings numbers. Where do you think earnings can be? How will earnings pan out this quarter? Do you think there is a recovery around the corner?
As far as earnings are concerned, I think we have been highlighting since last 2-3 months at least that earning cut cycle is now broadly behind. Most of the earning cut happened in last 1.5 years. And that earning cut is what it has led to is FY26 earning growth is in the single digit. I don't think there would be further big time earning cut from here.
Okay.
On the other hand, with low base effect and multiple steps which government has taken, including GST cut, tax cut, as well as the monetary policies, net outcome of it is there is good chance that FY27 earning growth will be better than FY26. And that you will start observing probably not in this earning season, but the earning season after this, you may be able to see it.
Okay, so this is like almost a bottoming out.
Yes.
Now, if we were to talk about how against all of this, you spoke about, how are you positioned in your portfolios?
As always, we focus on the growth and the quality company. It is just nature of the market caps and the way the stocks are spread over in the various market cap buckets. The large cap buckets are more heavy towards the consumption oriented sectors and associated stocks, which includes even financials as well. So the way our portfolios are structured are the large cap oriented funds are more into the consumption oriented sector, while the mid and small cap oriented funds are more into the investment part of economy.
Okay.
As a fund house, we are relatively lesser exposure to the exports part of economy. So the exposure in a diversified kind of category, which is a flexi cap or multi cap, ELSs, and large and mid cap. These categories, and that's where we always are preferring in this market over last 1 year or so.
Okay.
Is that because of its nature, you are exposed to both expensive as well as relatively cheaper stocks, and in this category you are exposed to both the consumption oriented as well as the B2B oriented companies, and that's where these diversified categories are more attractive for investors.
Okay. Now, what is your advice to investors how they should look at investing in the current scenario? Also, do you think, when markets are uncertain in a range-bound mode, should investors go for multi-asset allocation funds, or should they be invested across all the market caps? What would your advice to them be?
So one angle to it, which is already addressed, which is having exposure to all the market cap, which is a diversified categories, and diversified categories is definitely the choice for investors should be. If you want to diversify away from equity as such, then hybrid funds, in which multi-asset funds, wherein you can have exposure to debt, equity, along with that commodity and export markets. So that kind of diversification is really suitable for investors.
Thank you, Shreyash, for all your valuable insights. And I really hope that our investors have quite a few takeaways from this conversation. Please stay tuned into Moneynomics.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.